For decades, Japan's economy has played by a very unique set of rules. But in 2026, that's all changing. We are witnessing a historic pivot, a fundamental rewiring of not just Japan's economy, but the entire global financial system it has propped up for a generation. And let me be clear, this is not just a policy update. It's the end of a global economic chapter. So let's break down what's happening and why it matters to absolutely everyone.
You see, for the better part of 3 decades, Japan was the planet's primary source of cheap liquidity. Thanks to near zero, sometimes even negative interest rates, it basically served as the world's funding currency. It fueled everything from tech booms to housing bubbles all across the globe.
Well, that era is now definitively over. The policies that defined Japan's so-called lost decades have been dismantled. And the consequences? They're already starting to ripple across global markets. The bill for 30 years of cheap money is finally coming due. Okay, so let's start by digging into the sheer scale of this change. Because this isn't just some minor policy tweak. We're talking about the end of an entire economic era.
This massive shift is really anchored by a single number, 0.75%. In late 2025, the Bank of Japan, or the BOJ, raised its policy rate to a level we have not seen in 30 years. And the signals they're sending are crystal clear. This isn't a one-off. The BOJ is decisively taking its foot off the accelerator.
And this whole process, it has a name, the Great Normalization. It's this deliberate structural shift away from the policies of the past. The goal? An economy driven by sustainable growth, not decades of emergency monetary stimulus. Simply put, Japan is tearing up its old economic playbook and writing a new one. But you might be asking, why? Why make such a dramatic change right now? Well, the answer really lies at home. The domestic logic for strengthening the yen has become incredibly compelling. You know, for years, a weak yen was considered a feature, not a bug. It was great for exporters. But it also fueled this crippling imported inflation. The cost of energy and food just soared, putting a huge squeeze on Japanese families. The new strategy under the Takaichi administration is to pivot. A stronger yen now acts as a shield, protecting household purchasing power and, crucially, allowing those recent rage games to finally translate into real, domestic-led growth. And this wasn't some abstract economic problem. The pain was felt in kitchens all across the country. In 2025 alone, the weak yen was a major factor in a nearly 100% surge in the price of rice, a household staple. This was a daily reality that made a stronger currency an urgent political necessity. But at the very same time, something really remarkable was happening in the labor market. The 2025 Shunto, that's the spring wage negotiations, delivered a stunning 5.25% pay raise on average. That's a multi-decade high. So the government's #1 goal now is to make sure that this hard-won wage growth isn't just eaten up by inflation. But here's the twist. Solving a domestic problem has created a massive international one. This normalization comes at a price, and it's a price the rest of the world may have to pay. To really get the risk here, we have to talk about something called the yen carry trade. For decades, global investors have borrowed yen for practically nothing, then used that cash to buy higher-yielding assets everywhere else. Think U.S. stocks, emerging market bonds, you name it. It has been a core pillar of global liquidity for a very long time. So what happens now? As Japan's interest rates rise and the yen gets stronger, that trade becomes unprofitable, even dangerous. Investors are forced to unwind their positions. That means selling off global assets to buy yen just to repay their loans. A disorderly unwind could trigger a massive global liquidity shock, pulling capital out of markets all over the world. But the external risk isn't the only storm on the horizon. There's a huge internal risk, and it's anchored by this number, 237%. That is Japan's staggering government debt to GDP ratio, one of the highest in the developed world. Now, for years, this mountain of debt was manageable because borrowing costs were pinned near zero. But as interest rates normalize, the cost of servicing that debt explodes. And this has led to very real fears of a trust-style moment. You know, a reference to the 2022 UK crisis, where unfunded government spending triggered a complete collapse in investor confidence and a bond market meltdown. And if that wasn't enough, Japan is trying to navigate this transition in the middle of severe geopolitical turbulence. A diplomatic crisis with China has already resulted in trade restrictions on key goods. And, looking across the Pacific, the potential for new U.S. trade tariffs on exports like automobiles, adds another profound layer of uncertainty to the mix. So this all brings us to the central question. After you weigh the domestic logic against these massive global risks, is this great normalization a looming crisis, or is it a long overdue opportunity? While the verdict seems to be that this is a very high-stakes gamble, Japan is essentially trading a short-term period of volatility and pain for the long-term prize of a healthy, functioning economy. The consensus forecast really reflects the shift. Analysts are expecting the yen to strengthen to around 146 to the US dollar by the end of 2026. This appreciation is the key mechanism through which a lot of this economic rebalancing is going to happen. So, what should we be watching? This table gives us the key metrics. First, the BOJ policy rate. That shows the pace of tightening. Second, the 10-year Japanese government bond, or JGB, yield. That's the market's real-time vote of confidence in Japan's fiscal health. The narrowing gap with the U.S. Fed funds rate will drive the yen's strength. And critically, keep your eyes on that debt-to-GDP ratio. Is it actually trending down? Success or failure really lies in these numbers. And that leaves us with this final thought. For 30 years, the entire global economy has been built on the foundation of an abnormal Japan. Now, Japan is choosing to become normal again. And the real question is no longer whether Japan can handle it, but whether the rest of us can.